Welcome to another episode of China Update, where I provide you guys with the most up-to-date political, economic and geostrategic analysis on the world's number 2 economy. My name is Tony. Let's jump in. Okay, happy Friday everybody. I hope you've had a productive week and have a relaxing weekend ahead. One brief thing before we move into the main developments. The World Health Organization has confirmed that a 56-year-old Chinese woman from Guangdong province, southern China, has become the first person in the world to die from the H3N8 strain of bird flu, which is only rarely contracted by humans. The World Health Organization is currently investigating the case. Okay, let's begin with the big economic news from this week. We have a bunch of earnings reports from Chinese property developers for their performance in 2022, and the picture, unsurprisingly, is not pretty. There is so much red that, like so many 2022 company balance sheets we have been examining these last few weeks, once again, the word that comes to mind is bloodbath. A major theme we will be following over the next few quarters is, after 3 years of zero COVID, whether and how fast business balance sheets can recover. This, combined with the hoped rebound in household demand, are key to examining whether China will see healthy growth this year or unhealthy growth. This point is worth repeating. It is highly likely that China will see about 5% growth this year. It has the institutional system and tools to achieve this. The critical question is, will this be healthy growth, achieved through a rebound in household demand, private non-housing investment, and exports, thus giving policymakers enough room to push through greatly needed reforms to deal with China's medium-term systemic crises, e.g. housing, local government debt and fiscal system, pension reform, etc., or will we see unhealthy growth driven by debt-fueled non-productive government spending and housing investment kicking the can of reform once again down the road? This is the big question for the Chinese economy this year. My personal view, and this is just my personal view, is that the economic and political collapse of the entire Chinese system this year, as some anticipate, remains extremely unlikely. But China's economy is dealing with deep, difficult, ongoing systemic challenges after emerging from 3 years of zero COVID. Because we are following this at the granular level, day by day, a lot of economic coverage is going to necessarily be negative. If and when things do improve, then the coverage will reflect this. But for now, things are difficult for the Chinese economy, and we will continue to follow these developments. If I can make one final point while we are on this diversion, the cutthroat nature of the YouTube algorithm demands that creators use provocative titles and thumbnails in order to be shown to new viewers. This is the game that has to be played, for better or for worse. Regular viewers know, however, that I try very hard to ensure that the content within the videos themselves is always sober, grounded and fact-based. This very much remains my commitment to you all. Okay, let's move back into the theme of part 1, corporate balance sheets. Chinese property developers are especially important to examine as they were particularly savaged in 2022 and play a key role in regulator efforts to manage the ongoing housing crisis. Beijing embarked on a campaign in 2020 to rein in excessive borrowing in the industry, causing a sector-wide liquidity crisis, most infamously resulting in the Evergrande default. We remember, according to China Real Estate Information Corp, total value of new sales in 2022 by China's 100 biggest developers fell 41.6% year-on-year. Now let's look a little closer at how these developers did last year. Chinese financial media outlet Aviation once again provides a useful graph to visualize this, with the analysts expressing, quote, Chinese developers reported barrels of red ink for 2022 amid an unprecedented property slump and a crisis of confidence that hurt firms' home sales and squeezed their financing, end quote. According to data from Wind Information Corp, as of the 6th of April, among the 50 publicly traded Chinese real estate companies that have released their 2022 earnings, 24 saw their net income decline, while 16 recorded losses. Among these, 6 saw their deficits exceed 10 billion yuan, $1.5 billion. As we can see, Sunic China Holdings Limited, China's 11th largest developer by sales, was especially hit hard, seeing 27.7 billion yuan in losses. China Garden Holdings Limited, China's largest developer by sales volume in 2022, recorded its first annual loss since its Hong Kong listing in 2007. Did any stay out of the red? Tyson observes only a handful of stronger developers, such as China Vanke or Vanke Co. Limited and Longfor Group Holdings Limited, managed to post a slight increase in their 2022 profits by 0.4% and 2.1% respectively. The outlet also observes that while many players expected a tough year, many were still very surprised by just how bad it was. Quote, 2022 is the first time the company has suffered a net loss since its establishment 30 years ago. While this isn't an exception in the industry, the amount of losses still exceeded my expectations. End quote. The mid-sized developer saw over $1 billion in losses last year. In a separate report published also by Tyson this week, analysts observed once again a theme which we have been following for some time: the shift away from investing in smaller third and fourth tier cities to larger cities where there actually still is decent real demand. Indeed, the small handful of first and second tier cities may see recovery in their local housing markets this year. In Q1, prices of new homes in first-tier cities rose, while those for the rest of the country, representing the majority of the population, continued to decline. The housing crisis is entering a new phase, manifesting itself in the lower-tier cities. Quote, despite more local housing easing measures in recent months, we believe the property markets in lower-tier cities still face strong headwinds from weaker growth fundamentals than top-tier cities, including net population outflows and potential oversupply problems. End quote. As with so many systemic challenges the country is currently facing, the housing crisis is thus forming an acute regional rich-poor component. Developers are not out of the woods yet either. They now face a very different kind of challenge this year: significant pressure on debt repayment. Almost 1 trillion yuan, 958 billion yuan, $150 billion of onshore and offshore bonds will come due by the end of this year, for an industry which just saw its worst losses in decades. Next up, more on the economy. Hey guys, if you enjoyed today's episode of China Update, don't forget to hit that like button. It's just me making these episodes every day. It's a lot of work, but your guys' support is a huge source of motivation. Subscribing and sharing is a huge help as well, and for those who can go the extra mile and help me keep the channel financially sustainable, Patreon and Buy Me a Coffee links are in the description below. Thank you so much, everybody, for the ongoing support. Okay, the first half of today's video was quite pessimistic, but there are some bright spots on the economic front too. Yesterday we discussed the poor state of international travel in China, still lagging at a painful 20% of 2019 levels, despite China now having been open for 3 months. Fortunately, on the domestic side of things, China's civil aviation industry is looking somewhat better. According to data provider Flightmaster, during the first 3 months of 2023, domestic services have recovered to 80% of pre-pandemic levels. Still down, but in a much healthier position than international flights. For more on this, check out yesterday's video. Next up, another piece of positive news. China's exports saw a healthy increase in March, jumping 14.8% in US dollar terms year on year, beating expectations. US media outlet Bloomberg writes today that according to its survey of economists, analysts had forecast a more than 7% fall. adding, quote, "The surprisingly strong result was the biggest divergence from expectations since at least 2018, end quote. Many indeed were surprised by the jump in exports. Quote, "It was very surprising indeed. Much of the rebound was likely driven by easing supply disruptions. Its impact on exports and production was likely far more serious than previously envisioned. Therefore, today's data seem to suggest the slowdown in external demand is not as concerning as previously thought," end quote. The decline in imports, however, betrayed the weak state of household demand. Chinese analysts have also cautioned policymakers that they should not rely too much on similar surprise surges this year. Quote, "The wave of COVID outbreaks in December and January likely depleted factories' inventories. Now that factories are running at full capacity, they caught up the accumulated orders from the past. The strong export growth is unlikely to sustain given the weak global macro outlook," end quote. And, of course, not all commentators were particularly surprised by the March export performance. About a week ago, before this most recent data was published, Peking University's Michael Pettis expressed, quote, "Beijing is so worried about weakness in exports this year that it is demanding local governments take major steps to support export growth, which ultimately means implementing a whole series of additional subsidies to exporters. I suspect any decline in export growth this year will be much lower than expected, although that will be much less true for imports. China's trade surplus in 2023 will probably surprise on the high side," end quote. And this is what he observed today, after the publication of the March export data. Quote, "Once again, good export performance was not matched by good import performance. This should surprise us more than it does. Normally, export revenues should be recycled to workers in ways that boost consumption, and thus that boost imports. But clearly this isn't happening. What it suggests to me is that China's export growth was boosted by subsidies and implicit transfers that ultimately must have come from the household sector rather than from local governments, who are anyway too financially squeezed. Most analysts, including me, have been expecting a surge in consumption to drive overall GDP growth this year in a healthy way. But so far, it has been very hard to find evidence of that surge in consumption. This month's trade and inflation numbers don't help," end quote. Okay, that is today's episode of China Update. Thank you so much, everybody, for watching. Have a wonderful day wherever you are, and I will see you all tomorrow.